From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up in the race for Yellen's chair, John Taylor and Jay Powell emerge as frontrunners. Trump's tax cut effort takes a step forward in the Senate, driving Treasury yields higher. And the ECB prepares to unveil its next move. Better data is offset by some very ugly politics. We begin with a big issue, the race for the Fed chair.
Leadership matters, and who the chair is does make a difference.
I think there's a lot of good names on the list. I don't think with that list of names, even with Mrs. Yellen, who would not be my first choice, I don't think the president can make a bad choice.
I would say that the political considerations may outweigh the current economic situation. A new administration often just wants its own people on board.
The interesting part at the moment is this discussion is coming at a time when there's this so-called mystery about the low level of inflation. So the interpretation is actually quite important.
I think they would view Jay Powell as somebody to be much more continuous in the policy that we've been experiencing over the last several years.
More likely than not, we're going to have a very accomplished economist as the head of the chair of the Federal Reserve for the foreseeable future.
Joining me around the table in New York is Mike Collins, Senior Investment Officer at PGIM Fixed Income, and Bob Michele, CIO of the Head of the Global Fixed Income Currency and Commodities Group at JPMorgan Asset Management. Plus, from London, Marilyn Watson, Head of Fundamental Bond Strategy at BlackRock. Guys, great to have you with us on the programme. Let's just begin with where the odds are for the race for Fed chair, and the number one spot now seemingly is Jay Powell. But then at the number two spot, if you look at the two front runners, it's reportedly Jay Powell and John Taylor. And the spread between those two individuals, for me, Mike, is really quite wide.
Yeah, just in the last few days, Powell's odds, at least in the marketplace, have really soared, right? And I think part of it is because he's probably the one who's most conducive to a more continuation of existing policies, more of a certainty, less of an unknown, less risk to the markets. And, you know, Taylor's a little bit of a wild card.
Bob, how are you thinking about this at the moment?
So I'll take Jay Powell because he is a moderate. I think it'll be good for asset prices. I fear John Taylor, Kevin Warsh. I'd really want Gary Cohn in there, but it doesn't look like he's in the race anymore.
Explain to me why you'd really want Gary Cohn. Why would he be so good?
Because I think it's time to get a markets practitioner into the Fed seat and balance the econometric models of the ivory towers with the real world that we all have to deal with day in and day out.
I don't think I've heard anyone talk about Gary Cohn becoming the Fed chair for weeks, perhaps.
I thought I'd throw him in while you gave me the airtime.
Why not? I've heard Neil Kashkari get thrown in there as well. Marilyn, I just wonder, as you sit around a table with the guys at BlackRock over the last couple of weeks, anticipating the decision that could come any day now, how you approach a decision like this, if you can at all?
Well, I mean, we obviously look at the probabilities, we're looking at what the market is pricing in and obviously the leaks. But actually, when you look, as you mentioned, when you look at all of the different candidates, a lot is known about several of them. I think potentially when you look at Taylor, for example, and how hawkish he is going to be, I think that's also been overplayed. So actually, I think when you look at the list of candidates, some are on the more hawkish side, maybe Powell, maybe Yellen, are more sort of the status quo. But actually, it's, you know, it's one person. They will be leading the Fed, but they'll have one vote. And at the end of the day, they're going to be leading a committee. So we still are very much focused on the fundamentals and the committee as a whole at the Federal Reserve.
Well, Marilyn, talk to me about that. If it dropped across the Bloomberg terminal, big red headline that John Taylor had been nominated as the next Fed chair, would you be fading that move off the back of it?
Well, we would certainly expect to see more volatility. I mean, if you look at the Bloomberg terminal itself and where it's pricing in, where the Taylor rule is pricing in interest rates, then it's about 2.5% higher. But when you look at Taylor himself and what he has said, he's actually much more flexible in his approach to the unemployment rate. He's much more flexible in his approach. So I think we would look to trade the volatility and then probably fade it.
Mike,
but we would expect to see a flattener.
Yeah, I actually think the monetary policy implications for whoever the Fed governor is not that big of a deal. I think the monetary policy is on a pretty set course by and large. And remember, it's driven by the consensus of the committee. I think the regulatory policy is a bigger deal, right? And I think Trump wants someone who's a regulatory dove. And Taylor would probably fit that bill better.
There's a lot to think about here, Bob, and it's the push and pull down in D.C. I noticed the moves of the last couple of days. Mr. Powell the Politico story, the trial balloon, call it what you will, drives yields lower, then the tax cut story drives yields higher. And I wonder how that push and pull is going to play out over the next couple of months.
First of all, I don't think monetary policy can be put to the side. I think monetary policy is in a ridiculous place right now. And I think if you look at somebody like John Taylor coming in, why the markets aren't more frightened that the next Paul Volcker is coming in. He's got his rule. It's telling you it's 3 3/4%. And you know what? I think he's right. I think the period of distorted monetary policy is something of the past, and the Fed, the ECB, the Bank of Japan need to step up the pace to normalization. What comes out of Washington is something different than that. If we get some stimulus, what's the stimulus going to do? It's going to accelerate the recovery that we've already seen. So I can see rates buffeting back and forth between this. I don't know that has much to do with the Fed chair or stimulus. I think it's still a QE after effect.
Bob, I think a lot of people might have just watched what you said and sat there nodding their head. Yes, get out of the market. We want a real market back. But at the same time, Volcker back, really? He had real inflation to deal with, not inflation with a two-handle.
Or a one-handle.
Come on.
Well, inflation is picking up, and I'm going to pull up a chart because I get this all the time. People come in and they say, no, there's no inflation. And you see it. You see year-over-year wage gains coming up. You see the inflation across Europe, Japan, China. It's all picking up.
Is it picking up, Marilyn?
It is picking up to a certain extent, but I think still from very, very, very low levels. So it's all relative. It's certainly still low at very, very low levels.
Michael Collins, you'll be taking the other side of that trade, I assume?
All day long. I think if the Fed gets the funds rate anywhere near 3%, it's going to assure that we go into a recession and the stock market crashes, right? Just think about it. If you have a money market fund at 3 or 4%, everybody would take all of their money out of the markets and put it in money markets earning 3 or 4%. It's too good to be true. And on the inflation side, I actually am in the disinflationary camp, right? I'm looking at the anecdotal evidence of companies. There are very few, if any, companies in the world that have the ability to raise prices on their goods and services to consumers. In fact, it's the opposite. They're all cutting prices, fighting with each other for market share.
Bob Michele, you finally got your chart.
I found the chart I was looking for. What you're looking at is developed market core inflation and China core CPI year over year. This goes back to 2012. Where is the deflation? Where is the downside risk that the central banks are trying to respond to? They are behind the curve. It's starting to get away from them. You could look at the recent wage data in the jobs report. You can look at the Atlanta wage tracker. It's all headed one way.
So you two have joined me on this program since its inception through the year, and you've painted this picture of reflation, and Mike Collins has said, I'll take the other side of the trade. Mike Collins is in the money. Bob Michele's in trouble because yields are not where you thought they would be. So you could be right about inflation but wrong about the market?
It is true. And before you claim that I've been wrong about everything, I
certainly haven't done that.
I think yields could be higher and should be approaching 3% now. And the other thing we've seen is the weight of quantitative ease that's come in and suffocated the market. And it's that weight of the cash that has kept yields, I think, in a very narrow range, 215 to 250 for most of this year. There has been a bear market in bonds. It's been in the front end of the curve. That's where the Fed has surprised. They're going to raise rates in December. It will be the third time. It doesn't make any sense to me that they're still going this slow, unless you look at QE coming into the markets and supporting that.
I just wish we had a camera and a microphone in the commercial break for the conversation that Bob and I are about to have. Everyone's sticking with us. Mike Collins from PGIM Fixed Income, Bob Michele from JPMorgan Asset Management, and Marilyn Watson from BlackRock. Coming up, it's the auction block. Nathan's first bond offering since 2015 has the junk bond debt chowing down. That's coming up. This is Bloomberg Real Yield. Welcome back. I'm Jonathan Ferro. This is Bloomberg Real Yield. Just some breaking news and an update regarding Fed Chair Janet Yellen back at the White House. Said to be back at the White House, according to a person familiar with the matter. Of course, this appearance following a day after her interview with the President of the United States, Donald Trump. So Fed Chair Janet Yellen is said to be back at the White House. This is according to a person familiar with the matter. Bob Michele from JPMorgan Asset Management around the table with me in New York. Marilyn Watson from BlackRock over in London. And, of course, Michael Collins from PGIM with me as well. Looking at the situation here, we barely discussed Fed Chair Janet Yellen staying on as Fed Chair in the previous segment. Why, Bob?
Well, I think that her time has come and gone. I think she did well in the aftermath of the financial crisis, helping to continue Bernanke's policies. And I think the administration feels that they need a breath of fresh air to come in, particularly if they're trying to pull the rest of the Republicans along with them, and they're also trying to bring the rest of Congress with them.
So, Michael, for me, I thought she signed her resignation letter off the back of that Jackson Hole speech where she defended the regulatory regime. You've put the emphasis on deregulation. Is that ultimately what could sign the resignation letter as well?
I think so. She has pushed back pretty hard against Trump's, emphasis on deregulating the banks, right? And I think in her defense, that's the right move. I mean, one of the best things that's happened in this cycle with the regulatory pushback has been the fact that the banks are in as good a financial shape as they've ever been in our careers.
But they're not
right?
extending credit, though. That's the one problem. It is true the regulation has done a lot of very good things. Has it gone too far? Where's the extension of the credit? Why all this raise capital and then buy riskless government bonds, and in Europe at mostly negative yields?
Well, just to confirm the latest that we do have, Fed Chair Janet Yellen is said to be back at the White House. This is according to a person familiar with the matter. The appearance, of course, follows a day after her interview with the President of the United States. You asked where the credit is. Let's get it up on the screen for our viewers, shall we? Credit spreads, Bob, are as tight as they have been for quite a while across the whole quality spectrum. It couldn't get much tighter. That's where the credit is, right?
Well, it can get a lot tighter. I think most investors look at high yield at 5.5%. It doesn't strike them as high yield. They think high yield should be 7-8%. It's not the 5.5% yield or the 3.5% credit spread. It's the risk-free rate, which is about 2%, and it's the real yields, which are negative. And I've pulled up a chart where I look at real yields on the 10-year Treasury. You can see the distortion that's been created by quantitative ease and the growth of central bank balance sheets. So credit spreads at 350 over, frankly, at 1% defaults, what companies are doing with their balance sheets, I believe they should be 250 over.
Mike, weigh in.
Yeah, I think credit spreads are getting to the point where they're not only fully valued, but potentially overvalued, right? I mean, I'm looking at spreads across a lot of different corporate sectors, and they're basically at historical tights now. Over the last couple of weeks, and even in the last couple of days, we've seen a snap tighter in spreads with the optimism on tax reform. And we're pushing back against that. We're fading the credit rally a little bit here.
Marilyn, weigh in as well. Is this a sign of complacency, or is the risk-on mentality just here to stay?
Well, we certainly see the risk-on mentality being here for the time being. When you look at global growth, it's still on a very robust stance. When you look at global monetary policy and the global central banks, they are an inflection point. We do think they're going to reduce the very loose monetary policy. And when you look at the overall environment, when you look at where investors are putting their money, where they're trying to get yield, then emerging markets and credit are both two sectors that they are consensus trades, but we do feel that there's more to go, and we do feel that they actually still do have some value. But we are becoming increasingly cautious around the names that we invest in, and we think it's going to be incredibly important going forward to really pay attention to the risk, to the leverage, and to where you are investing in the credit.
Mike Collins, where are you selling?
Yeah, so we're selling double B rated credits in some cases at spreads in the low to mid 100s. And we're selling some double B credits inside 100 basis points because there is such a demand for the extra yield from investors around the world that they're not that price sensitive. And we're selling those and rotating into AAA asset-backed securities like commercial mortgage-backed securities, collateralized loan obligations at spreads at 100 or even higher in some cases. That is the easiest relative value trade in the markets.
I need to take a fee because I can make a market. You're going to sell them. And Bob Michele's on the other side of the trade buying?
Yeah, absolutely. I'm not selling credit in here. I don't believe we're anywhere near the tights. If you go back to 06, you go back to 96, credit spreads got to something like 250 over. That's where we're headed. We've got 100 basis points to go. Yeah, we're selling stuff. We're selling the markets that are distorted. It's the central banks who have bought the government bonds and compressed real yield. Get rid of that stuff. But right now, everyone's looking for credit. Marilyn's right. Corporate balance sheets, earnings, the quality of earnings, they all look pretty good.
Wait a second, though. Distorted markets exist across the whole fixed income environment.
This is true.
So how can, if you want to sell the distorted credits, I mean, that's it all, isn't it?
Well, no, I think there are a lot of things you can do. One is you can go into the loan market, so you take out the fixed rate component. The other is you can buy spread of credit. All of us can sell the treasury market against it to hedge interest rate sensitivity and just capture the credit spread. But you are right. If the Fed continues to normalize and the other central banks jump in, you are going to see a return of real yield to the market, and that will ripple through every asset class and every discount rate people are using in those asset classes.
Bob Michele from JPMorgan Asset Management, to Mike Collins from PGIM, and of course to Marilyn Watson from BlackRock. Sticking with me, I want to get you an update on where the bond market has been this week. 2s, 10s and 30s, choppy over the last 24 hours, that's for sure. Yields higher throughout the week by 7 basis points at the front end, by 9 at the long end on a 30-year, getting back up to 290. Still ahead, the final spread. The week ahead features a decision from Mario Draghi and the ECB. That's up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, Japan holds an election with Prime Minister Shinzo Abe favoured to win re-election. Senior lawmakers from the main pro-independence parties will meet in the Catalan Parliament. Plus, of course, you've got US GDP and, of course, the ECB decision as well. Still with us around the table, Mike Collins from PGIM Fixed Income, Bob Michele from JPMorgan Asset Management, and Marilyn Watson over in London from BlackRock. Guys, Fed Chair Janet Yellen said to be back at the White House, returning just a day after our interview with the President of the United States. That, according to a person familiar with the matter. Some choppy market action off the back of that, Bob. This Fed race is very, very difficult to interpret as an investor, as a market practitioner. How did you view just the headline risk around all of this?
So it looked to me like somebody assumed that she was there for a follow-up interview and she's the front runner. I don't think that's the case. I think she's being told she's not going to be the Fed chair and will be allowed a chance to step down.
Bob Michele, if I look at that situation, 24 hours later, this will get replayed. And we could all sound really, really stupid.
Been there before.
Why shouldn't he give her the job?
As I said, I think for a lot of things, I think Mike pointed out there's the whole regulatory issue. You want somebody in there who'll be a bit more balanced. And I think just get a breath of fresh air and get rid of these unconventional tools. They're distorting the markets. Let's go back to a markets-based economy.
We would love to go back to a market-based economy. The ECB is meeting next week, and they're set to unveil potentially, Michael, what they're going to do with their QE program. Now, do they cut it and extend it for a period of time, or cut it by even more and extend it for an even longer period of time? Which one's it going to be?
Yeah, so I think they telegraphed what they're going to do a little bit last week, right? Their staff came out with a report, and it looks like they're going to cut the purchases from $60 billion a month to something less, presumably $30 billion a month, and extend that, right? It's supposed to expire at the end of this year, this calendar year. Extend that through September of next year, so another 9 months.
Looking at that chart at the moment, I want to put it back. This is just remarkable. It's from Deutsche Bank, Bob. 7 times net issuance. That's the ECB's activity in this market. When they pare back, how significant is that going to be?
Well, it's going to be pretty significant, but they'll still be buying 3.5 times the net issuance. So they're still going to be in there distorting the markets. I think it's not the next, say, 9 months where they're going to cut the purchases in half. It's the 9 months after that. So you really have to get about a year from now to figure out how the markets are going to revalue.
Marilyn Watson, the situation for Treasuries when the Federal Reserve stepped back is that yields went lower. Why can the same thing not happen with bonds?
Well, bonds are already very, very, very low. Rates are still negative. And I think, as both Michael and Bob pointed out, it's going to be still a sustained period of time when the ECB is still buying. It's also our core view that they'll be buying about 30 billion from January to September next year. And then looking forward from then, that's when the forward guidance really comes into play, and when the market will start to look at whether interest rates might actually rise from a very negative rate. But when you look at the Eurozone economy as a whole, it's doing really well. It's continuing to grow, particularly when you look at Germany, Spain. Economic fundamentals are very, very positive. Even when you look at the labour market, it's continuing to tighten, albeit from very, very weak levels. So I think it's very, very difficult to see a situation in 2 or 3 years' time when you would still have negative rates.
Mike Collins, looking at the periphery at the moment, you told me last time you were buying Greece. Are you buying any of the other peripherals at the moment?
Yeah, so we're long a handful of the peripheral countries, right? And if you look at the credit spreads, I think they're still pretty wide. I think the Eurozone in general is seeing a real rebound in economic activity. I mean, they've been the star performer globally, and it feels like there's a coalescence happening politically in Europe as well. So we're actually pretty comfortable with some of the peripheral credits right now.
What's the trade in Europe for you?
The trade in euro for us is still corporate credit. We particularly euro high yield. Euro high yield looks great to us. We look at something like 10% of the universe is going to become a rising star, so it will move to investment grade. Can get yields of 2.5%. I take that all day long over peripheral Europe.
Guys, you're going to stay with us. The next segment right now, of course, is the rapid fire round. I ask the questions, you keep the answers as short as possible. The first one, Taylor, Powell, or Yellen? Mike Collins.
Powell.
Marilyn?
Powell.
Bob?
Powell.
Credit, wait for the correction, or it's not getting any cheaper? Mike?
I think you sell here and wait for an opportunity to buy at wider spreads.
Bob?
Buy all day long.
Marilyn?
Stay in it for now.
Bond yields, higher or lower year end? Higher or lower year end? Mike?
I'll say lower.
Bob?
Higher.
Marilyn?
Bond yields higher.
Guys, that does it for us. Thank you very much for joining me. To Mike Collins from PGIM Fixed Income, Bob Michele from JPMorgan Asset Management, and Marilyn Watson from BlackRock. That does it for us from New York. We will see you next Friday, the same time, the same place, 12 New York time, 5 p.m. in London. I imagine by then we might know who the next Fed chair is. This is Bloomberg Real Yield.